If you are thinking about applying for a waterways leisure tourism IPO, widely known to a consumer as Cordelia Cruises IPO, you need to pause and watch this video first. Yes, they operate as a virtual monopoly in India's domestic cruise sector. But behind the glitz and glamour, there is a massive hidden cash flow trap and newly formed subsidiary that most retail investors are completely ignoring. Everyone online is hyping about their sudden return to profitability and their massive 65% to 79% market share. But what if I told you that over 82% of the money you invest in this IPO is being routed straight to the tax haven in Gujarat? And what if I told you their operating cash flow just crashed to a negative 96 crore rupees? By the end of this video, you will know exactly what the big institutional investors know and whether you should bid for listing gains or run away fast. According to the red herring prospectus, the Waterways Leisure IPO is a 585 crore fresh issue opening on June 23rd and closing on June 25th. The Waterways Leisure IPO price band is set at 769 to 808 per equity share, requiring a minimum investment of 14,544 for a lot of 18 shares. Now, here is where the story gets intense. Cordelia Cruises essentially runs its entire empire on just one ship right now, the MV Empress. It is a massive 796 cabin vessel, but it was built in 1991, making it 35 years old. If anything mechanically happens to that single vessel, their entire revenue stream stops immediately. To fix this essential threat, the company originally filed draft papers to raise 727 crore, but mysteriously, the lead manager downsized the issue by nearly 20%, slashing it to 585 crore in the final prospectus. They had to adjust to secondary market realities. But that's not even the craziest part of their expansion plan. Where is your 585 crore actually going? Almost 480 crores is not staying with the parent company. It is being funneled to a newly formed step-down subsidiary called Bay Cruise Shipping and Leasing IFSC Private Limited. Why on earth would they do that? I will explain exactly how this maritime tax loophole works in a second. But first, you must look at their financials. On paper, the turnaround looks incredible. They went from painful 122 crore loss in fiscal 2024 to a massive 168 crore profit in fiscal 2025. But wait, that financial year 25 profit was pumped up by a 75 crore one-time exceptional gain. In fiscal 2026, their normalized profit dropped back down to just 52.14 crore. And remember that negative cash flow I teased earlier? In financial year 26, their operating cash flow bleed out to a negative 96.44 crore. Why did this happen? Because they are desperately trying to scale. Here is the payoff to that Gift City mystery. That subsidiary, Bay Cruise IFSC, was set up in Gujarat to secure a 10-year tax holiday and dodge heavy import duties. They are using your IPO money to pay massive upfront bareboat charter advances to lease two huge new ships from Norwegian Cruise Line and Norwegian Sky and Norwegian Sun. That aggressive $10 million advance lease payment is exactly what destroys financial year 26 cash flow. It is a high-stake gamble to triple their passenger capacity by 2027. So what does this mean for the Cordelia Cruise IPO GMP today and its real valuation? At the upper band of 888, institutional analysis shows the stock is priced at PE ratio of 50.37 times their financial year 26 earnings. That is quite expensive compared to premium domestic hotel chains like Chalet Hotels trading at 25x. Though it's cheaper than global giants like Royal Caribbean and the grey market premium, it is currently hovering around 20 to 18 rupees, 18 to 20 rupees. That implies a very muted listing gain of around 6 to 7%. Here is the final verdict for your Waterways Leisure Tourism IPO review. If you are an aggressive day trader looking for a massive overnight listing gain, this 6% GMP suggests you might be disappointed. But if You believe in India's booming travel sector and trust the management team to fill those two massive new ships despite a recent drop in passenger occupancy. This CRISIL triple B plus rated company could be a phenomenal long-term monopoly play. What do you think? Is the 35-year-old ship and negative cash flow too much risk, or is the 65% market share worth the investment? Let me know your strategy in the comments below. If this deep dive helped you see past the hype, hit the like button and subscribe for more institutional grade IPO analysis